Good evening, everyone. Thanks for coming out tonight for this inaugural event. Hopefully, every MIT Bitcoin meetup will be as robust. There's a whole thing on the West Coast about Stanford and Bitcoin and the Bitcoin group there. I think it's a bunch of crap. It should be MIT. Everyone should be coming out. I think MIT is a much better institution to be focused on disrupting the global monetary system and currency platforms that we have today. So I'm looking forward to hopefully getting to know more of you. I thought I would spend a little bit of time, just a little bit on myself, a little bit sort of how I got here, focus a little bit on what I believe are some of the fundamental issues that we have in our monetary and payment platforms, what Bitcoin specifically does, how it works, how it relates to that, and then I think we've got a good at least 30 or 40 minutes for Q&A, and I'll also invite my co-founder and CTO Sean Neville up for the Q&A as well. A little bit of my background and how I got here. Thanks for the introduction. I've been building internet software platforms and online services for about 20 years. My background before doing that was in international political economy, studying economics, political science, and philosophy. Those degrees weren't per se that useful when I started my career, but I think ultimately very helpful in how I think about the role of the internet in transforming society and the economy. Ultimately it was those interests that got me into the internet in the first place, and a belief in 1990, 91, 92 that a open, standards-based platform that was decentralized and distributed and based on open protocols could be used to build really disruptive kinds of technologies that would ultimately shape the world we live in. So I founded a company, Alaire, with my brother. We were based here in Cambridge, based on the idea that the web, which this was back in 1994, could be used as an operating system to build software, and that the future of software would be distributed through web browsers, and there would be a new architecture for software that was needed to do that. We built that company. We had 1 million customers around the world and built a public company, as noted, merged that with Macromedia and tried to transform the consumer experience of the internet with Flash, which was very successful, as noted, the most ubiquitously distributed piece of software in the history of computing. Through that, I got really excited about online media, and in particular, the idea that open protocols and open standards and the open internet could be used to reshape how television and video distribution took place. Founded a company called Brightcove, also based here in Cambridge. We were for 7 years at One Cambridge Center, and grew that to be a significant public company. Hopefully continue to be a significant public company. And I think the important thing is that I've always been interested in how can the internet as a whole and open standards and open software be used to transform a broad range of industries, whether it be the software industry or the media industry. But I think in this case specifically, we're entering a phase where the financial industry is ripe for disruption, and there's an opportunity to take advantage of open platforms to change the way that consumers and businesses interact with financial products, ultimately on a global scale. So, very specifically in terms of Circle and what we're doing here, I, about a year ago, or a little more than a year ago, went from being CEO of my last company to being chairman, and that freed me up to look at a lot of things. I had been exposed to digital currency and broader concepts of digital currency for about 10 years, but then very specifically Bitcoin and what Bitcoin was accomplishing organically about a year and a half ago. And about a year ago, I was able to really go much deeper on that, and I sort of went down the rabbit hole, haven't come back out yet. And I became very, very compelled by what I was discovering. I think, specifically, we're living in an era today where we have a deeply globally integrated society. We have a foundational platform that integrates that society, which is the internet, and the ability to have instant communications, instant media, instant knowledge discovery at effectively no cost. And that's driven an increase and a kind of increase in the velocity of human interaction around the world. As I looked more deeply at Bitcoin, I became convinced that this really held the kernel of being a platform that could really transform how money is stored, how money is used, how payments are made, and got very, very excited. When we step back, if we step back, say, 20 years ago, if I had told you that you're going to be able to send and receive communications instantly in text, audio, and video in the palm of your hands from any place in the world at no cost, you would have looked at me like I was a lunatic. Or if I had said that you're going to be able to instantly search all of the world's human knowledge from the palm of your hand at no cost, likewise, you would have looked at me like I was a lunatic. Yet today, we live in a world where to send and receive money or make payments takes days and introduces an incredible set of incremental taxes. And when you layer in jurisdictional boundaries and nation-state boundaries and so forth, it becomes a very, very cumbersome system. And so, to me at least, it seemed very clear that what we've experienced in media, what we've experienced in content publishing, what we've experienced in communications as sort of fundamental utilities that we can all use instantly, effectively at no cost, ought to be accessible to the world as a whole in the world of financial payments and how we use money. And so it struck me as really significant in that respect. The other piece was there were some very specific technical innovations that I got really excited about how Bitcoin was conceptualized, how it was developed, how it's evolved in its development, and how it can be used and applied. That got me very, very excited. And I've been in the sort of quote-unquote internet industry for a long time, and the closest analog I can think of to the excitement I've had around Bitcoin is the excitement I had when I downloaded and installed NCSA Mosaic, which was the first web browser that actually made HTTP and HTML, interesting as a way to interact with the internet. And I think we're at that stage. And it certainly, for me at least, has excited me at a similar level. Specifically, what are we talking about here? So our monetary and payment systems are actually, quite literally, pre-internet. If you think about the way you use and spend money today, the way you store your money, the way that money is sent to counterparties, whether that be a business or another individual, there are many, many layers that are involved in that. But literally, 20 years ago, when you wanted to communicate with someone asynchronously in England or in any other country, it took about a week because you had to, write a letter, and you had to put a stamp on it and send it, and those were sent through clearinghouses that were run by governments who would consolidate all those physical assets and then distribute them to their counterparties internationally, and it's a very slow process. Well, basically, our financial systems today are very similar for the average end user. Each country today maintains, or region, it's not always just a country, the European Union has the European Central Bank, but each country and each region has a central bank that is a central clearinghouse for payments and transactions. If you want to interact with someone in the global financial system, you have to manifest a transaction in your local bank that is then transmitted typically electronically to your nation's central bank. There's typically a system of then reconciling that transaction at a central bank level, transmitting it internationally, and so forth throughout the world. And you end up in a world where to send and receive money or make payments, whether you're a business receiving payments or a consumer sending and receiving money, that actually takes several days. So that's basically pre-internet. We can communicate in in sort of milliseconds around the world, but these sort of financial transactions are subject to systems and processes that literally the technology, in many cases, is effectively running on mainframes and doing batch processing with text files. And so we're dealing with an infrastructure that is pre-internet in many respects. And so that's the world we live in today. It is completely siloed by country. It is not interoperable globally. Every form of communications and media that we have today in the world is interoperable globally because of open standards on the internet. In the world of payments and finance, we have no such interoperability. And so there's an enormous amount of friction there, and likewise an enormous amount of expense. And that really leads to the next key piece here, which is that there are, in fact, platforms and products that exist today to help consumers and businesses use electronic means to make money transfers and payments. The card networks that we all rely on every day are great examples of that. In some cases, as consumers, the money transmission systems we use, like Western Union or money remittance systems, are also significant. But those are also fairly deeply flawed. Today, the average transaction has a tax applied to it of 2 to 3% of that transaction. Whether you're buying a cafe latte at a coffee shop or an automobile at an automobile dealership, irrespective of the actual cost it takes to process and confirm and verify and handle that transaction, there's this enormous expense that exists there today. For a business that accepts those payments, it actually doesn't happen instantly. The actual settlement of their funds takes several days as well. And so you might get the payment or you accept the payment, but it takes several days to actually handle that. There's also inherent in the existing system, not in every country in the world, certainly though in the US, there's material fraud and security risks that exist today. So every time you interact with a counterparty, whether that be a restaurant that you're buying something at or an online commerce store where you're making a transaction, you're essentially transmitting the keys to your bank account. Those credentials on your card, those numbers on your card and security codes and the like are literally keys to your bank account. If someone has those, they can spend your money. That's effectively what exists today. And as a result of that system, businesses who accept payments have had a system imposed on them where they have to focus on an incredible level of security around protecting these proprietary consumer financial credentials to ensure that people can't steal them. But obviously, we've seen that go awry, even in a place where a major top 10 retailer has invested in systems to protect that. Cyber criminals have hacked their point of sale and have taken those credentials on a massive scale. 100 million people in the United States, just in the last 2 months, had their financial credentials stolen at Target. And others as well, which have not yet been disclosed. But purportedly, it's dozens because the software that's been released to hack point-of-sale systems is freely available on the internet. And so, but we have a system, essentially, where every counterparty you interact with has to be a custodian of these financial credentials, and that creates a lot of fraud risk. And so the result is a system that has a kind of built-in insurance policy, which at face value sounds great, because if someone steals your credit card information, you can get paid back. But those are real expenses and real losses for businesses and banks as well. And so that's a real issue as well. I think when you start to operate at a global or international level where people want to accept payments from people from all around the world, which is obviously increasing as we're more globally integrated and take advantage of more online services, that becomes a greater challenge. When you talk specifically about person-to-person money transfer, it's even more bleak. Today, the individuals who have family and friends who live overseas, which because of the globalization of labor has increased fairly significantly over the past couple of decades, they're in a really bad place in that the average fee that they pay to send money as a remittance internationally is between 7 and 10% of the transaction fee, which frankly I think most of us would consider to be predatory. And these are typically families and individuals where that relative value is highly cherished. And so we have an international remittance system which is predatory and extremely expensive. The total volume annually, according to the World Bank, is about 500 billion US dollars. And so this is very material for a lot of people around the world. And so as we grow that sort of globalization and that interaction globally and more people want to do person-to-person payments, we've got to be able to come up with better ways to do that that are dramatically lower cost and reduce all these risks associated with fraud and theft and the like. So what does Bitcoin sort of specifically have to do with that, and how, what are the innovations here, how does it work, et cetera? I know the poster or whatnot sort of said, what is Bitcoin and why do I care? I'll try and spend a little bit of time on the what is Bitcoin piece. I'm guessing that a lot of you have read the popular press or you've read this or that, and some of you are probably fairly deep on the subject, so I'm not going to be able to communicate to every level of knowledge and expertise here. But certainly want to talk a little bit about what those innovations are and at least how I think about them and how does this all work. So, sort of first and foremost, a lot of people think about Bitcoin or digital currency more broadly as, a new currency or a new payment system. I think it's really important to step back a little bit from that and recognize that, Bitcoin specifically and digital currency more broadly, but we'll talk about Bitcoin here in particular, it's a distributed, decentralized, and democratic system of trust for transactions and ownership. And that's different than saying it's a currency, or it's different than saying it's a payment platform. At the core of Bitcoin is a system that allows for in a decentralized, distributed, and democratic manner, allows individuals to transact with each other in a manner where they don't know each other or where the trust is potentially low, and to transfer ownership of things. And today we think about transferring ownership of money, but actually underneath and built into these protocols are technologies that make this interesting to a lot of other things. So there are a bunch of pieces here which I'll just talk to just as a primer. The first is the sort of core piece of Bitcoin, which is this distributed ledger, or this distributed general ledger. So sort of foundationally in Bitcoin is a global general ledger that is a cryptographically verifiable ledger that essentially describes the ownership of digital units of account. Today, each unit of account is represented in Bitcoin, and I'll come back to that in a second. But at any node, anyone can download this software and install it on their computer, and they will synchronize with this global distributed ledger. And they will have a record of the ownership of units within that ledger. And everyone has that public general ledger. That's a really core foundational concept in this system. So start with, there's computers that have a ledger, and it's synchronized, and it's cryptographically verifiable, the units that are referred to in that ledger. Today, the units in that ledger are known as Bitcoin. And a lot of people talk about Bitcoin in terms of the total supply. Today, there are about 12.7 million Bitcoin. But it's really important to understand that Bitcoins are, in theory, infinitely divisible. And today, they're divisible to 8 decimal points. And so today, there aren't actually 12.7 million Bitcoin. There are about 1.27 quadrillion units of Bitcoin. So the ledger itself can support units up to that scale. About 1.27 quadrillion units can be referenced and reconciled on this global general ledger. The units themselves can be transferred between addresses using digital signatures and public key cryptography. And so what that means is that if I have units of Bitcoin in my address, and I want to transfer those units of Bitcoin to another address, I can do that in a cryptographically verifiable manner such that the network as a whole can confirm that indeed I have transferred those units to you as another party on the network. And there's no central clearinghouse that does it. It's a distributed decentralized network that confirms that and verifies that for everyone involved with that. The other benefit of this is in this model, the sender of those units of account doesn't need to disclose any personal identifiable information. They don't need to provide any particular financial credentials. Essentially, they're able to sign that message and that transaction with a private key. And the recipient knows at the time of receiving that transaction that the person who signed that message actually owns those assets. They know that those units that they have, that they actually own them, and can verify that at the time of transaction. And they don't need to carry any of that security risk of storing that individual's personal information or private information to use the system. So once units are transferred, actually what happens is that you can think of it as sending a message to the network. So I want to transfer units that I have on this ledger from my address to someone else's address. That's broadcasting a message to the network. And there are nodes on the network that act as what are called miners, which is a bit of a misnomer, but it's nonetheless still a helpful concept. And those are nodes on the network that actually watch for essentially new transactions that have come into the network and grab those and confirm them. They confirm them using these cryptographic methods. And once they've confirmed, once a certain number of those nodes on the network have confirmed that, then it's a valid transaction. So essentially, this is the sort of democratic and decentralized part of this network. Anyone can contribute computing resources to process and verify and confirm these transactions without a central clearinghouse or central authority. These miners do this for two reasons. One is that they have the ability to generate a small transaction fee that's associated with the transactions that are broadcast to the network, and that's typically very de minimis today. The bigger reason that they do this is that if they're the first node to what's called find a block, and they do that, a block is a collection of transactions that are new to the network. The way that they do that is by solving a cryptographic math problem. If they're the first to solve that problem, then they get to process that block of transactions, and they're rewarded with newly issued Bitcoin. And so the growth of the supply of Bitcoin is governed by a number of things, but as miners process transactions, they're rewarded as an incentive with that newly issued Bitcoin. And so these miners are both essentially providing the transaction verification and confirmation system for the global network, and they're de facto securing the network by contributing computing resources. Any third party that wanted to try and disrupt the network would need to overwhelm the total computing power of the network to do that. And there are estimates on what that looks like today. The various estimates range from it's a $500 million to $1.5 billion investment today in computing power to be able to overwhelm that network. The other piece here, and this is really important when we're talking about a kind of global digital currency, is that this is all built on open source technology and open standards, and it operates very transparently in the world. And when you look at the software that we use day to day, whether it be browsing the internet or sending email or interacting with the internet as a whole, an enormous number of the layers of what you're interacting with are based on open source and open standards. And this is really, I think, very, very fundamentally important, which is that if we're going to have a global digital currency that is adoptable anywhere in the world, it's really critical that it be open and transparent and be based on open standards that can be democratically contributed to and so forth. And so that is a really critical piece of this. This is not a company that's trying to do this. This is not a single government that's trying to do this. This is a broadly developed open technology that anyone can build on top of. There are a lot of applications for what I've described as this sort of platform for storing units of account and transferring those units of account in a decentralized manner. The most common kind of model that people think about today with Bitcoin is sort of as a currency and a payment system. Exchanges that exist, and there are quite a few of these exchanges that exist today, that allow people to think of it as purchasing slots on that general ledger. So you have X amount of dollars or euro or yen or whatever, and you want to purchase some slots on that general ledger. Well, a quote-unquote full slot, which would be 1 BTC or 1 Bitcoin, has an exchange value. People value that today for its utility value and its potential future value as a global monetary and payment system. And so you can purchase those through exchanges. The price mechanism for that today is a free-floating kind of marketplace. There are multiple exchanges. I think what you're going to see in the next year is quite a few new exchanges that launch that are more institutionally focused and support institutional trading and pricing mechanisms. But essentially, you can, through an exchange, buy some slots on this network to own units of account in Bitcoin. Once you own those slots on the network, you can use that to send and receive them to anyone on the planet effectively at no cost. And so, in a sense, those slots have a value that is its free-floating exchange value to existing fiat currencies. And as you send and receive them, the users that send and receive them can exchange them likewise through these exchanges into their local currencies for use in those economic systems. The sort of focus on Bitcoin as a kind of currency and payment platform I think is an appropriate one because that's a very significant one and it relates to some of the issues that we talked about in the existing monetary and payment systems. But there are a lot of other really compelling uses of this technology. When you conceptualize this as a sort of decentralized, distributed, general ledger that can be used to demonstrate ownership with a system of trust around it, that can be used in a lot of ways. So there are some concepts that are out there that people talk about. There's the concept of colored coins. Think of it this way. If you've got a small unit of Bitcoin and you can attach some metadata to that small unit of Bitcoin and quote-unquote color that coin, and you have the ability to then, in a cryptographically verifiable manner, transfer ownership of that unit from one person to another person, then you have the ability to manifest forms of essentially title and property transfer in a decentralized, distributed manner that works anywhere in the world. And so a lot of people are starting to think about how can you use this distributed ledger and this digital bearer instrument to manifest forms of smart property, to manifest forms of representing title to objects, whether they be virtual or physical, and to make that work on an international or domestic basis. So there's some really exciting things that can be done with that, and that's really basically possible today on top of the stack that's there. There's some other concepts which is, built into these protocols is a mechanism to execute script. And specifically, it's a set of code that runs that handles some of the specific kinds of transactions that the Bitcoin network handles today. But that's somewhat constrained in what it can do. But even what it can do today is still powerful. So for example, if you wanted to have a transaction which involved multiple parties and multiple signatories, you can do that today, such that if you wanted, I'll just use a basic real-world example. If you are parents and you have a kid and you want to give the kid some money and you want the kid to be able to spend money above a certain threshold, but if they want to spend money above a certain threshold, it requires at least two or at least one signature from a parent. Then you can manifest a kind of financial contract between parent and child that is enforceable over this network, again, without a centralized authority to manifest that. And so, in general, these sort of escrow mechanisms, multiple signature transactions, enable us to conceptualize various methods of financial contracts that can be run over this network and run in this globally distributed system. And I like to think about, and this is from Sean, who I'll have come up in a few minutes, is the Bitcoin network is actually a massive distributed computing network. It is a massively distributed computing network that can run a fairly constrained set of algorithms today, but as that technology evolves, it's going to be able to do a great deal more. So the sort of use cases for this go well beyond the trivial use cases that we think about and hear about in the popular press today. Where are we today? We're in the 1994 of Bitcoin and digital currency. So there was a web browser that shipped in late 1993, NCSA Mosaic, and people got really excited and said, wow, this web thing's really cool. And people started to think about, how do we build commercial businesses on top of this? How do we make this accessible to a mainstream user base with software and services to take advantage of that? And businesses started to issue press releases that said, we have a website, isn't that amazing? And we're in a very similar place with Bitcoin and digital currency today. The software has gotten a lot of people excited. It's gotten broad interest and attraction, but we're still really in a very immature stage of this today. And I think a lot of the quote-unquote debates that happen out there are very binary and polarized, like Bitcoin won't work or Bitcoin will work. And it's a very naive point of view, because this technology and the businesses that are built around it are going to rapidly evolve. And the innovation in the core software that supports it is going to rapidly evolve. And we're going to be looking at a radically different world a year from now, 2 years from now, 5 years from now, 10 years from now. And I predict in 10 years, we will look at what's happened in this space much like we looked back at what happened with the birth of the web. We're in a very, very similar place. So today we have very immature infrastructure, which has scalability issues, that has some security issues. We have a very emerging and nascent market for exchanges, which actually allow interoperability between digital currency and fiat currency. These exchanges are run in lots of different locations around the world, but guess what? There's not a single serious exchange running in the US. There's not a serious exchange running in London, but there's a boatload of private equity and venture capital that are going into those companies that are building those right now. And so I think what we're going to see is we're going to see some very exciting businesses emerge, Circle notwithstanding. Hopefully it's great. That are focused on this exchange problem and associated kind of infrastructure development that needs to happen there. But in general, there's a very lack of high-quality products for your average consumer or your average business that wants to take advantage of some of the benefits that I've talked about. And so we're sort of pre-Netscape in the era of the web, as a corollary here in the era of Bitcoin. But it's also a very rapidly evolving environment. The number of startups on a worldwide basis, there's probably 1,000 startups today all around the world, in virtually every country in the world, that are building wallets, exchanges, other merchant services, other tools around this. And I would say it's not surprising that several of the very top-ranked private investors in the world, venture capital investors, have made very significant investments here. And so we're in the early stages, and I think it's premature to be dismissive of where we see the technology today and its adoption versus what we're going to see happen over the next 5 years. So very quickly, I'm going to touch on Circle, and then we'll open it up for Q&A. So what are we doing? So we're a venture-backed company. We're focused on making digital currency and Bitcoin accessible to a mainstream audience of consumers and businesses. There's sort of two things that we're doing. We haven't launched our products yet. We're getting close. The first is for consumers. We want to make it very, very easy to purchase digital currency, to store that in a highly secure way so that you don't have to worry about it being stolen, and then providing applications that can be used on smartphones, tablets, and PCs to send and receive digital currency and make payments with it. including kind of touchless payments on a person-to-person or person-to-merchant basis. And then for businesses and charities and other types of organizations, we're going to be providing products that allow them to accept digital currency payments with a model where they don't pay a percentage of their transaction as a fee, which is the predominant model in electronic payments today, and where they don't actually have to carry the price risk or the intraday volatility risk of the price, where we shield them from that and allow them to essentially have same-day direct deposits into their bank account in their local currency for the payments that they've accepted, and we'll provide them the tools to accept those payments through their websites or e-commerce sites or in applications or in a person-to-person basis through an application that they'd use at a quote-unquote point of sale. We're a regulated business here in the United States. We're regulated by the Treasury Department as a money transmitter. So that means we have a set of compliance requirements for knowing who our customers are, monitoring transactions, reporting suspicious activity, and trying to address issues of money laundering and fraud. And so those are key parts of what we're doing in our products and are really important to mainstream success. And we're working with a variety of federal agencies and state oversight departments to make sure what we're doing is compliant with their expectations. We're trying to build this company globally, and so there's a similar process that we have to go through in a variety of international markets to ultimately build what we're doing. So that's what I wanted to share, and I hope that was helpful. Thank you.
Did you want to bring up your co-founder now?
Sean, do you want to come up? One of the things that we've really pushed for is to have a uniform or national approach specifically around digital currency kind of licensing that would allow companies in a much more streamlined manner to, in a consistent way across the country, get a license. And then the compliance side of things, actually, there are some fantastic startups that are focused on both the kind of compliance human resource sort of skill set, and then there's startups that are very focused on essentially the infrastructure for know your customer, anti-money laundering. And you could think of those as sort of, software as a service or scalable products. And so, if those things happen, I think it's viable for more businesses to be licensed on a national basis. But if you're trying to come up with innovations that build on top of the software that's there today, there's nothing that necessarily is going to force you into being a regulated business. And so I think that there's an enormous amount of room for people to work on projects that advance the state of the art or new ideas that are built on top of this that aren't going to be ultimately tied to being a regulated money services business.
So, question about security. The other venture-backed startup in this space is Coinbase, and they make a big deal about how they store a lot of 90%, now even more, offline. What are some clever approaches to security that you guys are adopting that other exchanges aren't?
Sure. You want to take that?
Sure.
Go ahead.
Yeah, so I think for a service like Coinbase, usually the key separation is how many of those private keys do you have online in some form, no matter how well protected. So there's a sort of matter of protecting a certain percentage of online keys that can be used to sign transactions right away. And then there's sort of the second issue of what percentage of those keys do you keep offline in a completely separate location not connected to the network, and how do you secure those? And they're really two different kinds of security. So there's a sort of percentage throttle back and forth, which goes where, and that sort of determines where you need to really focus the brunt of your security. So obviously you want to put it in both places. But the reality is, no matter how secure you make an online location, you can use the best military-grade hardware security modules behind multiple firewalls with the best systems you can come up with, and excuse me, and they can still be penetrated. You have to assume that they can be penetrated, right? The devil is in the details. So that's a high-level sort of answer that a lot of us give as we're building cloud services to do this. But the devil's in the details. I think we have a very different approach to how we manage offline storage, but that's something that we don't generally disclose. But it is different, and I think we'll share more and more of that as we sort of roll out the product. I think we do a lot that's different in the online case as well, and that's also something that we may not disclose. But it is a key issue. Certainly, for when I got into Bitcoin, I use offline wallets. I use watch-only wallets. I use Armory for a lot of my stuff, and I sort of discovered that as Bitcoin has accumulated in value, I feel like I have a bunch of money stuffed under my mattress. So I actually want someone who is a trusted, secure custodian of this money under my mattress. So I think we need to share enough to let people know as transparently as we possibly can that we are that custodian. But also we don't want to open any security breaches by oversharing too much information.
So if you're going to use Bitcoins and you're trying to do rapid transactions, say with your company, how do you get around the issue that it takes around 7 minutes to verify each blockchain and you have to wait, according to the prescription of the protocol, 4 or 5 blockchains before you know something is secure? So it's like 40 minutes. How do you get around that problem or address that?
Okay. Yeah, so there are a couple answers, but I think the key sort of technical piece is there's a difference between being able to validate a transaction, which you can do instantly, and confirming a transaction. So if Jeremy sends me money, I can validate right away that he owned the private key. He had the ability to sign that transaction. I can't be sure that he's not going to send you the money as well. So really the confirmation and the weight is on protecting that double spend problem. So it turns out in practice, the double spend is reasonably difficult to do. For a certain threshold of purchases, it just doesn't make sense to attempt to double spend small value transactions. So in certain cases, it may make sense for, say, the coffee shop owner or the food truck to say, I just care about transaction validation. I don't actually care about the double spend problem, particularly if their sort of wallet service is hosted with a custodian who shields them from some of that danger. So that's sort of part of the answer. The other sort of technical answer is it's a problem. It's a problem that the blockchain itself for on-chain transactions can only accommodate about 5 to 7 transactions per second because of how slow it is to get new blocks into the network. And it's something that's going to have to be addressed, and people are working on sort of the technical issue of how they ramp up transaction volume in a meaningful way. And there are a lot of different sort of thoughts about how to do it, ranging from the typical sort of microtransaction approach of just batching up a bunch of separate transactions into one new logical transaction, and a number of other sort of approaches. None of them are sort of winning out yet, but it's one of those problems that will have to be addressed. And then the final piece is for some services, say like a Coinbase or a cloud service. If you are a merchant and you're selling me a cup of coffee and I'm a customer of that same service, that custodian knows that we both have those private keys and can essentially swap the private keys of the unspent outputs in an off-chain transaction without even bothering with the blockchain. There's no chance that it could be double spent. So that's an optimization that is possible to make for some cloud services.
The outlook in the regulatory environment, it's a multi-layered issue. This is not a sort of binary, it's great, it's bad. What I would say is, first and foremost, I actually think the United States has been the most progressive country in the world in thinking about and applying regulations in this space. They are leading the market. They are the first country to issue guidance and provide a framework for commercial operations of a business. And we're interacting with a lot of regulatory agencies in the US, and I think there's a genuine understanding that this is a significant and innovative and disruptive technology that has a lot of potential human benefit, and are wanting to make sure that criminals can't abuse it and customers or consumers can't be defrauded, and so are trying to get their heads wrapped around that. That's really different than in a lot of other places in the world. I think in China, it's really a capital control issue, which is sort of closing off an escape valve to allow capital to flow out of China in a free-floating manner. There have been sort of warnings issued around the world, and I think they're all pretty reasonable. There's price volatility. You could lose all your money. Your digital wallet could be stolen and it's subject to theft. And without proper controls, this could be abused by money launderers and criminals. Those are all true. Those are all accurate today. And so sort of having a perspective that says, we've got challenges and let's come up with a regulatory model that ensures that consumers' funds can't be easily stolen, that ensures that bad actors are kept off these platforms. Those are reasonable, I think. And so I think what you will see unfold over the next couple of years is digital currency fitting into broader, regulatory frameworks that apply to electronic money transmission, payments platforms, and the like, that will create issues where there are, I think very clearly, parts of the digital currency community that are very focused on being anti-government and anti-central bank and supporting total anonymity. And I think you'll see some forking in the communities where there's people who sort of focus on that, and there's people who focus on the more fundamental economic and consumer benefits of this, but operate in a legal manner. And so I think you'll see that as a way that some of this unfolds over the next year or two. The question is sort of the tax implications. So this is an area that we have been pressing, and a lot of people have been pressing for official government guidance. And I think you're going to see official government guidance come from many, many governments around the world this year on this issue, in part because there's, in theory, hundreds of millions, if not billions of dollars of tax revenue that's on the table because of all the value that's appreciated and transactions that have taken place. But specifically, there has to be guidance in the U.S. from the IRS and in other jurisdictions, a similar regulatory body that specifically stipulate if you purchase and hold and own and it appreciates, how is that taxed? If you receive income as payment, how is that taxed as part of your aggregated income statements? And so we expect to see guidance from the IRS in the U.S. this year. They've said that publicly, that they intend to do that. There are some scenarios that I think would be better or worse in terms of that tax classification. I won't get into all the details here, but I think that's a critical piece to broad business acceptance. So people understand where they, both investors, consumers, and businesses understand, where they stand with this new asset class. We have a market today which is a very, very nascent market, meaning, the total, daily trade volume for quite a while. In fact, all of January was like 10,000 Bitcoins a day. And it's been, 20 or 30,000 Bitcoins a day in just the past few days. That's like a small cap stock on NASDAQ, one equity, not the aggregate of NASDAQ. It's like one equity. We're talking about very low trading volume with highly illiquid exchanges. And that's going to create price volatility. And so we have an environment that is essentially subject to more price volatility. If you want to move $5 million in and out of this, you're going to disrupt the price. And so, a big thing that I've been saying publicly and saying to regulators and others is that we very much need institutionally funded or private equity funded exchanges that operate in the U.S. and in London and in other key financial markets that are focused on providing higher volume, higher velocity, that can support institutional traders, that can support pricing mechanisms such as derivatives and short positions and hedging that are important to create price stability. And so those are really necessary, and I think a lot of really smart people and a lot of really smart capital are focused on that problem right now, and we're going to see those companies and businesses emerge over the next year. Today at least, Bitcoin has achieved global network effects that are significant. It has a base of technical contribution and entrepreneurial activity that no other platform has today. I think those kinds of features give it a very significant chance of being a dominant platform. I think when we're talking about global currency and interoperable global currency, having common standards actually matters a great deal. Having a highly fragmented marketplace is not that helpful to global interoperability of payments. And so I think there's a built-in kind of inertia that is associated with that. With that said, a lot of people have taken the Bitcoin source code and tried to come up with improvements or changes to various dimensions of it. And there's a whole universe of people who are, day traders in lots of different cryptocurrencies, and I think that's mostly uninteresting. But there are some good ideas that are emerging from some of those other projects, and I am hopeful that those ideas can be kind of incorporated into the Bitcoin project itself over time. But it's not a foregone conclusion that Bitcoin is the only platform that will exist here. Clearly, there's room for a lot of innovation. I don't know if you want to add to that.
Yeah, yeah, I think that's right. There are a lot of technical innovations that are happening in altcoins, and my guess is that Satoshi didn't really anticipate what happened on the mining side of things. But the technical advancements in the altcoins, I haven't seen any yet that leap out to me as something that can't be accommodated in Bitcoin. And then sort of simultaneously, Bitcoin just has this level of escape velocity where there's just so many nodes globally. So as Jeremy sort of was speaking about it earlier, this sort of the way transactions are signed and the way keys are verified, that's actually not sort of hard coded into Bitcoin. What happens is that these scripts, these opcodes are executed. So what we really have is this massive sort of distributed interpreter that can interpret this script. It's just that right now that script only does two things, really. It verifies transactions and it generates Coinbase transactions, which is how miners get new coins. But it can do a little bit more than that. It is pretty limited, but just the idea of having a piece of software that's that widely distributed, that's not centralized, it's not controlled by anyone, that's pretty appealing. It's not something that any of the altcoins, aside from sort of discussions about pump and dump and that, it's not anything that any of the other altcoins have managed to replicate. And then, sort of finally, for us, we really believe in this sort of hybrid economy notion of fiat currency doesn't really go away. Fiat currency and digital currency cooperate, and there are optimizations of one another.
Question is sort of around what do we think of Apple's sort of ban on Bitcoin apps, and what are the implications? So first of all, Apple has not banned any app that has anything to do with Bitcoin. They've specifically not allowed apps that allow for people to exchange money for Bitcoin or send and receive and make payments with Bitcoin. The public kind of communication that has gone out to some of the companies that had apps that were removed was that it had to do with a question of legality of those apps, that the apps must be legal in all jurisdictions where those apps are available. And so at face value, it appears to be a scenario where they're being risk averse and saying, well, geez, if this app is being used in a location where it's not actually legal, we're not allowing that to happen. Apple has Department of Justice staff that live on site. And so there may just be a heightened sensitivity to, we don't want to get a call that said someone was using an app on the App Store to do X, Y, or Z, and so forth. That's one explanation, which is essentially the risk-averse explanation. And there's probably some merit to that. The second is sort of a belief that, Apple has its own digital payments products coming that take advantage of, iBeacon and other proprietary features in iOS, and they want to have as much of a kind of leg up or advantage as possible in this sort of move to digital payments. I'm not convinced that that's a significant issue per se. What does it mean? It's unfortunate because the App Store distribution model is a way to reach a lot of consumers, and you can do things in a native app that you can't do in a HTML5 application. But I think there's an enormous percentage of what you can do in a native app that you can also do in a browser-based app. And I think you're going to see great apps that work on iOS that aren't installed through the App Store, but which meet 95% of what people would want from them that are through browsers. And I think to the degree that over time there's more clarity from Apple, that you'll see, ultimately they'll allow those apps in.
Yeah, that's a really good answer, and that's exactly what I believe too. But I just want to add that it sucks, and I switched to Android.